Welcome everybody to our webinar today. Thank you for joining us. This is Merge Scheme Mayhem, our end of year survival guide for accountants. This is our penultimate webinar session of the year. We have one more next week, which is our monthly app showcase session. So if you're not already a customer of ours and you'd like to see a tour of our software and find out a bit more about how we support firms like yours, then that's the session to join, and I'll leave some details about that in the chat a bit later on. I'm Sue's Commercial Director here at WhisperClaims, and your host for today is our MD, co-founder, and our subject expert, Jen Badger. Hello, Jen.
Hello.
Okay, so as you will all be very aware, this year has been the first almost year operating under the merged RDEC and ERIS schemes. And we've spent the past 12 months or so breaking down different parts of the changes, from overseas costs to subcontracting, transitional rules, NI ERIS, all of it, to help accountants and advisors like yourselves feel confident in preparing their first merged scheme claims. And with December, a notoriously busy month for submissions and the first major deadline under the new rules nearly upon us, we wanted to bring everything together in one place. So if you've been following our sessions for much of 2025, a lot of what you'll hear today may sound familiar and hopefully a welcome refresher. We've got, as I said already, quite a big audience today, a really good mix of our own customers and new names in the room. So for those of you who may not know us very well yet, we're WhisperClaims, and we provide specialist software and support to accountants and advisors, delivering R&DTax advice to their clients. We don't prepare claims, that's your job. We're here to help you do it with more structure, more efficiency, and with guardrails to keep you on the right side of HMRC. And each month we run sessions like these to help spread knowledge, tackle tricky areas of the legislation, and bring clarity to topics that tend to generate the most debate or confusion in the R&D tax space. And those are usually sparked by the types of questions and conversations we have over our advice line and in our WhatsApp community as well. As we go through today's session, Jen's going to be referencing resources that we've shared in the past, and I'll be sharing links to said resources in the chat. We're really looking forward to your questions later on in the Q&A. So because the chat box is going to be quite busy, it would be really great if any questions that you have for later on are submitted via the Q&A box that you'll find somewhere in the middle of your Zoom ribbon. If you happen to forget, don't worry, and you post in the chat, don't worry, we'll be watching both channels. We just don't want anything to get missed. And just finally, of course, we will be sharing a recording from today along with a full breakdown of all the references and resources. So don't worry if you miss anything. A comprehensive roundup will be in your inbox either tomorrow or on Thursday. I'm going to hand over to Jen now, who's going to take us through the agenda for today.
Cool. Thanks, Suze. So yeah, obviously we've done our introduction. So I'm going to try an attempt in this short time to cover merge scheme, the new rules, the updates, everything like that. Talk a bit about Northern Irish ERIS and grants, and cover pre-notification and the changes to the additional information form, as well as a few kind of bits and pieces to think about as we go into 2026, which sounds very strange to say out loud. We will be galloping through it quite quickly because obviously it's a huge amount to cover in the short time we have. But as Sue said, she'll be sharing resources as we go along, and then you'll get in the kind of follow-up to the session, Suze will make sure to link to all of the full-length webinars, for example, on each of those topics, as well as blogs we've written and some of our ebooks. So I might not remember to mention it, but Suze will be sharing it, and we will see how we go. So before I kick off talking about the merge scheme, I think Suze has a quick poll she's going to put up for us.
Yeah, this is always a tense moment as to whether the polls will come up. But just before we get started, we wanted to just take a quick temperature check to see where everyone's at with their merge scheme claims. With so much change, it would be great just to hear what stage you're at. So here's the first poll we have. Are you currently working on claims? Have you completed them? Have you started but not finished? Have you read the rules but haven't touched a live claim yet? Are you not ready at all and you're hoping that today's session will bring you some clarity and close some gaps? Oh, we've got a couple of tiebreakers there. So we've got lots of people who are actually have already completed claims. Quite a few who have read the rules but haven't touched a claim yet. That's really good. So it seems like a lot of you have been battle tested already. It would be great to get some insights from you later on in the Q&A. Yeah, so hopefully today we'll tighten up any blind spots for anybody that anyone has, and for anyone who hasn't done a claim yet, it will be useful. So thank you everyone for sharing. That's really handy. And Desmond, I'll just end that poll and back over to you.
Cool, thanks, Suze. I think that result is pretty much exactly what I would have expected given where we are in the year, that some people have done a few claims and quite a lot of people have started or not done any, which, as we say, with most claim periods under the merge scheme ending at the end of March last year, or the first ones ending at the end of March this year. Yes. Obviously, major deadlines are just coming up in December, so we'd expect to see people be putting more and more through. Right, let me just get back to my slides. Okay, so merge scheme. So the merge scheme rules apply to claims for periods starting on or after the 1st of April 2024. So obviously, as I say, those claim periods starting on or after 1st of April 2024, we're starting to see hit those tax deadlines for the claims ending March 25. So as it's starting to wash through, I was just looking at our stats. So we've seen 67 claims go through our app that are actually for merge scheme, which is it's only about sort of 20% of the claims we've actually had through this year. So it's still quite a small proportion, but we're expecting that to increase over the next 6 months to the point where it's most claims. We'll see how it goes. So the major changes that we saw with the merge scheme coming in is obviously it's theoretically one scheme. We'll talk about why that's not really true. But all claims now give an expenditure credit of 20%, all new RDEC claims. Uses the current SME PAYE cap rules. Basically, what this means is the overall tax benefit is now 15% for profitable companies and 16.2% for loss-making companies. Now, I know that that's not entirely 100% accurate, but basically it means that all claims being made through, I'm going to start calling it new RDEC just to be very clear. All claims made through new RDEC have that same expenditure credit. We also saw the ERIS scheme brought in, so the enhanced R&D intensive scheme coming in to replace the R&D intensive scheme. So ERIS, for all intents and purposes, is very similar to the old SME scheme in that it is purely for SMEs. It's for SMEs that do a lot of R&D. I will talk a bit more about it later in more detail. So we are still, much as this is the merge scheme or merge schemes, we still have 2/3 schemes running in parallel for different companies, different places, that kind of thing. Major changes that we saw the rules make to claims were that subcontractor costs are now allowed for all claimants, including large companies. So up to this point, large companies have not been able to claim their subcontractor costs. The new rules incorporated the expected ban on overseas subcontractor and EPW costs. So again, I'll talk about that in a lot more detail. And key thing is grants and subsidies no longer affect most claims. I was saying all claims, it's now most claims, and I will talk about Northern Irish ERIS and why you still need to think about grants a little bit later. So just to dig into those major changes, subcontractor costs, obviously a big thing. They're now allowable for all claimants, including large companies. So all claims made through ERIS, Northern Irish ERIS, or new RDEC can all include all subcontractor costs. And the other, I think, really positive step that's come in with the new rules is a really good clarification of who can claim for subcontractor costs, where it's subcontracted R&D. So as you can see on the slide, company can claim for R&D work done on their behalf. So they have subcontracted out some of their R&D if they enter into a contract. So there has to be a contract for the work to be done for them. The activities to meet the contract include R&D. So it can't just be supply me these things that will create no R&D at all. There has to be some R&D. And it's reasonable to assume that they intended R&D of the sorts to be carried out when entering into the contract. Now, the wording of that is a little bit lengthier in the legislation. The key thing here is that somebody at the company that's contracting out this R&D is a competent professional, can understand the R&D that's needed, understands that the R&D is needed in the first place, and therefore it's reasonable to assume they knew about it and would want it done. HMRC have stated in some of the R&D consultative forum meetings that it's not enough to just have a clause in a contract that says if any R&D is done, it's ours. There's got to be a kind of contemporary assessment of the work. Someone at the contracting company has to know that the R&D is taking place. You can't just have a blanket clause. So it's going to be an interesting phase as people kind of work through this and how it works in real life. The converse to this is companies can claim for work they have done to fulfill a contract if they took the initiative to undertake the R&D. The company contracting out the work did not intend for or know about the R&D being done to fulfill the contract, and the work meets HMRC's criteria for eligible R&D on its own. So it can't be that it was part of someone else's R&D, but doesn't constitute R&D in its own right. It has to be something. So this takes away all of the confusion we've had over the last few years, where you've got a bakery subcontracting some software work where potentially that bakery could actually claim for it. Now they wouldn't be able to because they wouldn't know, understand, or intend for R&D to be done for them. And the company that's doing that R&D to fulfill a contract would own that R&D and therefore be able to claim the costs. So this should, over time, really clarify, make it quite easy to work out who can claim for what bits of subcontracted R&D. However, there are some transitional rules I'm not going to go into here because they're quite complicated. But obviously, you can see that you could have a situation where a subcontractor and their the company that subcontracted the work to them have different year ends and are therefore making their claims under either the old rules or the new rules, and therefore there would be some confusion about who can claim. So I think Sue's will probably be sharing a blog we've written about this. If not, she'll share it at some point. Just it goes into a lot more detail about how these transitional rules apply. Obviously, for this first load of claims going through towards now and the end of December, it's probably a really good idea to read up on those transitional rules just to make sure you're not causing double dipping inadvertently. Okay, overseas cost restrictions have now come in. So the thing here, the difference this makes is that payments made to overseas EPWs and subcontractors are no longer allowable costs. So overall, don't include payments made to overseas EPWs and subcontractors. So what that means for EPWs, you can only claim for payments made to EPWs if they're subject to UK PAYE, and it doesn't matter where the EPW is based. So if you've got an EPW based in Cyprus who is paid through UK PAYE, pays UK taxes, then that's absolutely fine. You could theoretically have an EPW who has come from Cyprus to the UK and is still paid under Cypriot's payroll, that they wouldn't actually be allowed to be included because it's not going through UK PAYE. So you've got to be a little bit careful about how that you've got PAYE references and you've checked that everyone is paying the tax on it. In situations where maybe they're paid half under a different jurisdiction, half under UK PAYE, you can only include the portion that is through UK PAYE. It's slightly different for subcontractors. So it's only the cost of work carried out in the UK that can be included. So the work has to be physically done in the UK. It doesn't matter the nationality of the company, nationality of the subcontractor, where the payment is sent, the currency of the payment, anything like that. The important thing here is that the work is done within the UK. So as you can imagine, you could have someone that is normally based in France come over, do the work physically in the UK, and that would be absolutely fine and can be included. So that's probably a little bit more difficult to work out because this will need to be found out from the subcontractor themselves in some cases of where did they physically do the work. Also means that if you're employing a UK subcontractor who happens to be a digital nomad and spends 3 months in Spain whilst working on the project, again, those costs couldn't be included. So there's quite a lot of nuance there and there's quite a lot of questions going to have to be asked. Having said all that, there are exemptions to this. So if the conditions required for the R&D to take place do not exist or not available easily in the UK, you can claim those overseas costs. So the example that HMRC first gave was if you're doing research into volcanoes and there isn't currently an active volcano in the UK, obviously you'd need to go and probably use local workers, local subcontractors to do the R&D. People said this wasn't a very widely applicable example, but a good one. Other examples they've given are, for example, where you're maybe working in motorsports and the prototype cars have to be tested on a particular type of track, and that isn't something that is available in the UK, and the costs of replicating that in the UK would be prohibitive to the R&D, then using a facility overseas is fine. The key thing to remember here is that doing the R&D overseas because it costs less or there are more workers available can't be used as a reason to do that. So you can't say, I couldn't find software developers in the UK, so I've outsourced it to Ukraine, and that's, therefore I'm exempt. That is not true. If it's only cost or availability of workers, it's the reason the work was done overseas, you can't claim those costs. So you've got to be, again, a little bit careful looking at the reasons why things were done overseas, whether it could have been done in the UK and all that kind of thing, and looking at where people are, PAYE. So there's quite a lot there to kind of think about as you're claiming for EPWs and subcontractors. And then, of course, as I said, we have the ERIS scheme, which replaces the R&D intensive SME scheme. So the R&D intensive SME scheme, I'm sure everyone has seen, it's very short-lived, really, because it only applies to expenditure incurred after the 1st of April 2023, and then is replaced for claim periods starting on or after 1st April 2024. So it's only a short period where we're ever going to see R&D intensive SME scheme claims being made. So this was claimable by post R&D loss-making SMEs. So it's okay if they're profitable as long as they're making a loss after their R&D expenditure enhancement is applied, whose R&D spend is at least 40% of the total expenditure for the claim period. And what this allows them to do is access payable credit of 14.5% rather than 10%, which gives an overall benefit of 27%. So again, that's been in play for a little while. I think everyone's kind of familiar with it. So under the new rules, the enhanced R&D intensive scheme replaces. So ERIS came in. So this again is same with all of the new RDEC claims. It applies to claim periods starting or after the 1st of April 2024. So they reduced the expenditure limit to 30%. So as long as the R&D spend is at least 30% of total expenditure, companies will qualify for this. Merge scheme rules apply for everything, subcontractors, EPWs, all of those things we talked about, grants, everything like that applies under the merge scheme rules for those things apply. The key difference is that companies must be loss-making before the enhanced R&D expenditure is applied. So it has cut it down. So we have just, again, been looking at our stats. Pre-merge scheme, the vast majority of claims were being made through the SME scheme. Now we're seeing under the ERIS scheme, it's actually a lot smaller. We're seeing it as about maybe 20% of claims, maybe less. I think actually looking at my numbers, yeah, it's about 20%. So it's a much lower percentage than you would have seen for SME or even R&D intensive SME. Key thing to remember as well is that special rules apply to companies with a registered address in Northern Ireland. I'm going to take a moment to take a breath. I think Susie's probably got some more resources to share around merge scheme stuff. And I apologize for the speed I'm going through this, but as I say, a lot to cover. So that's your key things you need to know about the R&D, the merged schemes. And now we're going to talk, actually I'm going to skip forward after that because I forgot about it. And now we're going to talk about Northern Irish ERIS. So as I was just saying, under the rules of the ERIS scheme, there are special rules again for companies with a registered address in Northern Ireland. So this is because essentially, I think companies in Northern Ireland pointed out that they will work with subcontractors, EPWs, people like that based in the Republic of Ireland so regularly that this would make no sense. And obviously there's a Northern Ireland protocol post-Brexit, which means that applying the same rules for ERIS in Northern Ireland just wouldn't have worked. So it only, as I say, it only applies to companies with a registered address in Northern Ireland. So that's just a key point there. It doesn't matter if they're trading in Ireland, whether they've got offices, facilities, whatever it is, they have to have a registered address there. Sorry, I need to move my phone video pictures because I can't see my slides properly. So it's companies with a registration in Northern Ireland and that have a trade in goods or trade involving activities with electricity, or they don't have a trade in goods or electricity and they have not opted out of the Northern Ireland provisions. So companies that don't carry out trade in goods and don't do anything with electricity can opt out of the Northern Ireland provisions and claim under normal ERIS, for want of a better term. But the key differences in Northern Irish ERIS are that the overseas restrictions do not apply. So they can claim for any overseas subcontractors, EPWs, without any issues, but the benefit is capped according to de minimis rules. So it's very much a kind of swings and roundabout situation. Northern Irish companies can always choose to make the claim through new RDEC instead of Northern Irish ERIS. So even if they can't opt out and claim through normal ERIS, they can choose to claim through RDEC. So it's quite a lot of calculations you need to be looking at about whether if there's lots of overseas costs, it's probably worth using Northern Irish ERIS, even if the benefit is capped. However, if the benefit is capped and they don't have many overseas restrictions, it might be worth doing it through RDEC. So there's a lot to think about there. So just to summarize this again, so the comparison between RDEC, ERIS and Northern Irish ERIS. So for both ERIS and Northern Irish ERIS, the company has to be loss-making before the R&D enhancement is applied. That doesn't apply to RDEC claims. For both ERIS and Northern Irish ERIS, the company has to be an SME, which doesn't apply to RDEC either. The company has to have a registered office in Northern Ireland to be able to claim Northern Irish ERIS, which doesn't apply to RDEC or ERIS. The qualifying expenditure has to be more than 30% of overall expenditure for ERIS and Northern Irish ERIS, but not RDEC. And obviously under RDEC and ERIS, the overseas expenditure is restricted, which it is not under Northern Irish ERIS. However, Northern Irish ERIS is subject to de minimis limits, unlike RDEC and ERIS. So you can see that it's very similar to the ERIS scheme, except you've got that switch between being allowed to claim for overseas costs, but having that cap and of the de minimis limits. So, as I've said before, all companies can choose to claim through RDEC rather than Northern Irish ERIS. Companies that do not carry out in trading goods or activities related to electricity can choose to opt out, as I said before, and claim through ERIS. But companies that do carry out trading goods or activities related to electricity cannot opt out. So they can only claim through Northern Irish ERIS or RDEC. So those are the ones you really need to think about, is the companies that can't opt out and therefore are going to have to make a choice between Northern Irish ERIS or RDEC when they're making their claim. And it will come down to that relative balance between including all the overseas costs, but being capped by the de minimis limits. So, as they're exempt from restrictions on overseas subcontractors and EPW costs. However, obviously, if they opt out of it, the overseas restrictions apply again. Or if a company qualifies for Northern Irish ERIS but chooses to claim the new RDEC, again, the overseas restrictions apply. So just to hammer home that you only have that exemption from overseas restrictions if they're claiming through Northern Irish ERIS. It is not a case that companies with a registered address in Northern Ireland are exempt from those restrictions. They have to be based in Northern Ireland and claiming through Northern Irish ERIS. So just to be absolutely belt and braces clear, Northern Irish companies based in Northern Ireland and claiming through Northern Irish ERIS are exempt from those restrictions. Now, the de minimis limits, again, anyone who's done anything with grants will know that companies that receive de minimis aid are restricted in how much they can receive over a 3-year period. So for most companies, this is 300,000 euros. If they're operating in agriculture, it's 50,000 euros. If they're operating in fisheries or aquaculture, it's 30,000 euros. Now, there are some nuances here around if it's mixed, if some of their activities are in agriculture and the rest are not, then potentially the limits change. I'm not going to go into that here because I don't have the time. Key things when you're thinking about Northern Irish ERIS is that when we're talking about a 3-year period, we're talking about the benefits received for the last 3 accounting periods. So in change, when you're looking at grants received, you'd be looking at a rolling 36-month period. Here, you're looking at what was received for the last 3 accounting periods. So it doesn't make any difference the dates of something being paid out or anything like that. It does include support received by group companies. So if you've got a group of companies all claiming Northern Irish ERIS, potentially had grants, you're going to hit the cap quite quickly, potentially. So you do need to be looking in detail at all the group companies and everything like that. So to work out whether a Northern Irish ERIS claim will breach the de minimis limits, you've got to add together any de minimis aid received by the company in the previous 3 years, so any grants, anything like that. And that can include employment allowance, because that obviously is de minimis aid. Any de minimis aid received by any group company in the previous 3 years. So that is, again, any previous ERIS claims, anything like that, any grants. And then you need to look at the difference between tax benefit received by the company or any group company from previous Northern Irish ERIS claims in the 3-year period and the amount of RDEC that would have been received. So this is where it gets very complicated. But say a previous claim, they got £50,000 through Northern Irish ERIS, but actually would have only received £25,000 if they'd made the claim through RDEC, then it's that £25,000 difference that you need to add together when you're looking at the de minimis limit. So it can be quite complicated. Obviously, for this year, none of the companies you'd be claiming for will have previous Northern Irish ERIS claims, so it should be fairly straightforward. But as people start claiming regularly through Northern Irish ERIS, this is something that's going to need to be looked at in detail every single year and make sure that you've got the details of the breakdown of the eligible expenditure, how much of that was overseas costs, what they would have received through RDEC, all of that to be able to kind of make sure you've got that information for the next years and potentially 3 years' time. So it's going to be an interesting process of seeing how companies manage to navigate these challenges of having all that information to hand. And as I've said twice already, but the key thing to remember is if that information isn't accessible, if there's no way to find out what de minimis aid group companies received, the company can always fall back to claiming through RDEC. So it's not a problem not to have the information. It doesn't preclude them from claiming R&D tax relief overall. It just means they can't claim through Northern Irish ERIS if they can't check that information. So again, information is going to need to be gathered is any de minimis saved by the claimant company, any group companies, amounts of employment allowance claimed by the claimant company and any group companies, and then obviously everything about the previous ERIS claims. So it's going to be a lot, it's going to be a big change for companies operating, registered in Northern Ireland and operating there compared to companies in the rest of the UK. Oh, another quick breather for me. And then we're going to jump into pre-notification.
Okay, there,
I
Jen.
can't find the right spot. Yeah, I'm
Can
doing good. I'm doing well. Sorry, keep on to me the pictures because the slides are slightly different. Yes, so pre-notification is a drum that we have been banging for the last year or so. So this obviously has slightly different time periods than the merge scheme stuff that we have been talking about. So pre-notification, as I hope everyone on this call now knows, applies to accounting periods starting on or after the 1st of April 2023. So for any claim period starting after the 1st of April 2023, you need to look at it, and some of those claims will need you to submit a claim notification form. This can be referred to as the advanced notification form or pre-notification form. I don't like using ANF because it's too close to AIF and there's enough confusion out there already, so we're going to call it CNF. Completed and submitted through an online portal and requires details about a company, its projects, high-level summary of R&D activities. So on the surface of it, pretty simple, but as I think everyone knows, over the last year, I think people started to have missed deadlines for pre-notification this time last year, and we are still seeing a lot of claims being missed because of missed pre-notification deadlines or misunderstandings about the pre-notification deadline. So first question we get about pre-notification is always how much detail is required. And I'm still going to say it's hard to say. We have had some information. We spoke to someone at one of the professional bodies and they said they know that if it's just a mashed keyboard amount of information, then that will be rejected immediately. If it's just we did some R&D, HMRC will ask further questions. But beyond that, it's really, really hard to know how much is the right amount of information. We still haven't had much feedback from HMRC about this. As you can see on the slide, the guidance says a summary of high-level planned activities. So it's really hard to know. And obviously the timing affects this. The pre-notification can be submitted any time from the first day of the accounting period. So before any R&D has taken place, you could potentially be submitting this form. So at that point, you'd be saying, well, they plan to do this versus could be on the very last day of the claim notification window, in which case all of the work will be done. Probably the accounts are starting to be pulled together. You've got a lot more information at that point and could give a much longer summary. It's hard to know. It is just one box on the form though, so it's a bit. I'm going to try. Oh, I can flip to that side now. Excellent. So this is the absolute key thing that is killing people with claim notifications and actually causing a lot of claims to be invalid. So the claim notification form has to be submitted within the claim notification period. So this runs from the first day of the accounting period to 6 months after the end of the accounting period. So for an accounting period ending 31st March 2025, the claim notification period is 1st April 2024 to the 30th of September 2025. So you do have 18 months to submit a claim notification form. For longer periods of account, the claim notification period is the same for both accounting periods. So if you have a period of account starting 1st of January 2024 that's been extended to 30th of June 2025, the claim notification period is 1st January 2024 to 31st December 2025. And that applies even where obviously the accounting period from the 1st January 2024 would end on 31st December 2024. So it does extend it for that first period. So, and as long as you do it sometime within that window, you're absolutely fine. Now, when you combine that information about the timing with actually who has to submit the notification form, this is where it's been getting very messy. So a company has to submit the notification form if they've never claimed R&D tax relief. So if this is a first time claim, absolutely has to be done. I was speaking to a company the other day that have only been in business for just coming up a year, and they were asking about R&D tax relief. And my first thing I said to them is, do your claim notification form. Don't wait till the end of your accounting period. Do it today. Just go back and do it. We are seeing a lot of companies who are maybe 2 years into operation now wanting to do their first claims and realizing they've missed their first year because they've gone past that 6-month deadline. So for companies that have never claimed before, they're absolutely going to have to do it anyone that's working with startups, new companies, just tell them to do it today. Just absolutely do it. From the minute they incorporate, they should be filling in that form. Otherwise, a company has to submit a claim notification form if their last claim was submitted more than 3 years before the end of the claim notification period, or the only claim they've submitted in the 3 years up to the end of the claim notification period was for an accounting period starting before the 1st of April and submitted as an amendment after that date. So that has caught a lot of people out where their last couple of claims have been amendments submitted after the 1st of April 2023 and don't count, or the claim is rejected by HMRC and removed from the company tax return. Now, one thing I have seen quite a lot more recently, as this is washed through, is people are aware of claim notification, they know there's the rules about it, but they are confused about how the interaction between previous claims and the claim notification period. So we've got people who've still got claims for periods that don't need claim notification, and they are under the impression that as long as you submit that previous claim before the more recent one, then that previous claim will count. If this is after the end of the claim notification period for the more recent claim, that claim won't count. It doesn't matter that you're going to get it in before you put it in. It's all about the claim notification period. So it is very easy to have a claim from prior to 1st April 2023 that's still just about not timed out, but the claim notification window has closed for your 2024 or 2025 claim. So just to emphasize, if you've missed the window and no claim has been submitted in that window, it doesn't matter now if you submit a previous claim. You've still lost your more recent claim if you've been waiting to submit the previous one. So our advice these days is just do a claim notification form. If you think there's any chance there's any R&D, there's any chance of making a claim, just submit it. Because HMRC will reject the claim if the claim notification form hasn't been submitted, and we are seeing a lot of rejections coming through. And there's absolutely nothing they can do. They have said there might be exceptions to this for exceptional circumstances. We have had one client telling us that they have had written confirmation from HMRC that they could submit a late claim that hasn't had pre-notification done. I'm not sure whether it went through yet. If I was trying to do this, I would want HMRC to have put this in writing for me that these are exceptional circumstances and they will accept the claim. But yeah, many claims have been rejected over the last year or so, usually falling foul of the amended returns rule. And remember that inquiries will be a problem in future if previous claims are rejected after the end of the claim notification period. So if you go, it's fine, I've got a previous claim, and then that claim is inquired into potentially before the end of the claim notification period, but is rejected afterwards and suddenly doesn't count anymore, you're going to have issues. So again, our advice is to just submit a claim notification form. Just do it. There's nothing in the guidance, no feedback yet, suggesting there's consequences of submitting a claim notification form and not submitting a claim. And the risks of not having done one are really high. Obviously, robust processes are important, check previous claims, submit CNFs when needed, all of that kind of thing. However, 100%, if you think there's any chance of it doing it, use any confusion about whether a claim notification form is needed, I would just do one. It doesn't take very long at all. The information needed is quite small. So as long as you can get a 1-paragraph summary of the projects from your client, it's 100% worth doing it. I didn't used to say this, I have to say, but as I've seen this washing through, I'm like, no, just do it. Just do it. It's not worth the risk of missing them. Quick breather again. Okay, just a couple of slides on the AIF before we get to questions. Still says clams, I've realized. So this is mandatory for clams and claims. So we have the claim notification form and the additional information form. And one of the sources of confusion has been from people who know they need to do, for example, the additional information form, but go to the claim notification form by mistake, and they're told they can't do it because it's timed out, even though the claim itself is fine. Or they think that because they've done the additional information form, they didn't need to do the claim notification form. There's a huge amount of confusion between the two. And again, that's why we've made sure our wording is that we're talking about the CNF claim notification form as opposed to the additional information form or AIF. So the claim notification form is not mandatory for all claims. It's only for the ones we discussed. First-time claims, no claim within the window, whereas additional information form is absolutely mandatory for everything. You cannot get a claim to go through without it. The submission deadline for the claim notification form is within 6 months of the end of the claim period. So you've got a really quite a short window to do that, whereas the additional information form has to be submitted before the CT600 and therefore within 2 years of the end of the claim period, same as the hard deadline for making any claims. So as long as the additional information form is submitted before the CT600 that it relates to, that should be absolutely fine. Doesn't matter where in the 2 years after the end of the claim period you submit it. So you can see the much shorter window for claim notification versus the additional information form. And then the form length, the CNF is very short. It's a high level summary, honestly, 10 minutes and it's done. Whereas the additional information form needs detailed project descriptions, breakdowns of costs, all of that kind of thing. So it's a much longer, much more detailed form. Probably takes, depending on how you prepare the information, somewhere between 20 minutes and an hour to fill out once you put all the information together. So yeah, CNF is conditional, it's time sensitive, and the AIF is always required and far more detailed. And just to be clear, submitting the claim notification form does not remove the need to complete and submit an AIF. Completing and submitting an AIF doesn't mean that you didn't need to do a claim notification form. So you can do everything right, but if you didn't do a claim notification form, your claim will be rejected. And just a couple of last points about the additional information form. So for merge scheme claims to be made under ERIS, Northern Irish ERIS, or new RDEC, the key differences with the AIF are you need a lot more details about subcontractors and EPWs. So they're looking for registered company of subcontracting companies, PAYE references for EPWs. They're looking for company registration number for UK companies if you're including them as a subcontractor. We're assuming this means that they can then go away and look at whether that company has made a claim and have matched those up to make sure there's no double dipping. You need to know where the work was carried out. Was it in the UK or overseas? And you need to know the reasons for the exemption to overseas restrictions if the company is claiming that. The other thing to note is that the ERIS and merge scheme RDEC or new RDEC are treated as two separate schemes within the AIF. Now, I have to say, again, I was looking at the stats this morning, of the 67 merged scheme claims we've had, none of them have had spending in both RDEC and ERIS categories. So people are tending to do them one or the other. There might be reasons you want to split them between the two. There's not many reasons why you don't split them between the two, but you might want to. So if you are splitting the cost between ERIS and merge scheme, you've just got to work out an almost arbitrary way of doing that because there's nothing about the projects themselves that would put them into the ERIS or RDEC buckets. So you've just got to be careful to make sure that if you are splitting it, you've made sure that all the costs line up, all the splits line up so that your AIF isn't, you don't find yourself in a frustrating loop of it saying you've not covered enough, you've not covered 50% of this, you've not covered this doesn't add up, that kind of thing. And then the other thing you will need if you're claiming for companies based in Northern Ireland is details of their address, registered, and their company number, and obviously any de minimis, any previous de minimis aid, all of that kind of thing if they're claiming Northern Irish ERIS. But at bare minimum, you need their address because it will ask you whether you're claiming to Northern Irish ERIS and then ask further questions. So the AIF has some changes. Those are the big ones. Everything else about it is fairly similar. So it's just making sure that you, before you start filling out the AIF, have gathered all the information, especially about subcontractors and EPWs, because that doesn't matter whether they're overseas or not. You have to provide that for all of them. Oh, now that was a very fast 40 minutes of talking about everything to do that everyone needs to be thinking about at this time of the year. So while I get my breath back, I think I'm going to go with a quick poll before we jump into the questions.
Yeah, thanks, Jen. So let me just grab. So before we move into the Q&A, it'd be great to just get a feel for where you all feel that there is risk or uncertainty. Let me just see if this is gonna launch. It's always a slight worry. Hopefully you can all see that. I don't know, Jen, can you see that poll? Is that
Yes.
up?
Yep.
Yeah. So what feels most risky now having heard everything that Jen's mentioned and obviously your experiences for those of you that are already preparing or have already prepared claims? Is it overseas costs and EPWs? Is it the subcontracting rules, transitional periods, ERIS and grants, project narratives? Good to get your opinions. I'll just give you all a couple of seconds just to get your answers in. We've got a couple that are leading just now. Certainly subcontracting feels like one that is a risky area, which it always has been. Now even more so with the new rules. Lots of uncertainty. Okay. We don't expect there to be huge amounts for the Northern Ireland, can never get my words, Northern Ireland ERIS ones, I suppose, because it's a less popular scheme to be claiming through, but that's interesting. Anything that jumps out on you there, Jen?
I'm not surprised. I think it's interesting that subcontracting rules, I think I'm going to make some assumptions, some leaps here that that's because they have changed. And we were doing it one way, we were then flipped to doing it another way, and now we're doing it a different way again. So I think there's a lot to be thinking about in terms of that. And obviously, transitional periods, I think the combination of those transitional periods with the new rules around subcontracting are going to make it difficult. And it's also, as I mentioned over the slides, is that some of the stuff around subcontracting is a lot more difficult to access. So things like overseas EPWs, you know or not whether they've got PAYE references or not. That's quite a simple thing to look up. But looking at contracts, transitional periods, different year ends, all that kind of thing, the information that you need to make the decisions is also slightly less accessible. So I think obviously one key thing I'd flag up would be start doing these claims a wee bit earlier than you maybe have in the past, because if you're going to have to go to the subcontractors and find out what their year end is and whether they're claiming R&D to then be able to know whether their costs can be included in this claim, you're going to need time to go up and down that chain and work that all out. But the other thing, obviously, Susan and I were discussing before putting this poll up, this is a really good way for us to target our advice as we go into the new year. Obviously, people are worried about subcontracting and transitional rules, and we will plan some webinars based on that in future.
Absolutely. Great. Okay, I will stop sharing that.
Cool. I've managed to make my slides go. Okay. Actually, I forgot I had my year-end thoughts. I will give you my year-end thoughts now that I've got my breath back again, and then we'll go straight to questions. So I hesitate to say this today, but we're not expecting any R&D tax relief changes in the budget. There's been nothing, there's been no chatter, nothing kind of trailed anywhere. Normally, you know that some changes are coming. We're not expecting to see anything. We haven't actually seen many changes in the last couple of budgets, really. So we're not expecting any big legislative changes. However, there are some things that we think, as 2026 wears on, still sounds weird, as I say, to say 2026, but fine, that will impact R&D advisors. So there's the changes to AML supervision from the 1st of April 2026, theoretically, probably, maybe. So obviously, I would say that everyone on this call, all accountants should be AML registered, but I think we'll see a little bit of upheaval, kerfuffle potentially as that's brought in, and could affect kind of smaller advisors and that kind of thing. So it'll be interesting to see how that goes through. We've obviously got the mandatory registration for tax advisors coming into the 1st of April 2026. So again, this shouldn't affect many accountants. Most of them should already be registered in the right way. But for any advisors that are not currently registered with HMRC, this will block them from being able to liaise with HMRC about their clients or their clients' claims. So it's going to be an interesting process again to see how this goes. Hopefully this will weed out even more of the bad players, as we like to call them, in this sector. We'll just have to see. It does mean that anyone that wants to talk to HMRC about R&D tax relief in any way will have to abide by certain standards. So hopefully, again, this will just keep the process we've been through the last few years of raising standards, reducing the kind of levels of outright fraud within the scheme, and keep cleaning it up for everyone. But we'll see how that goes. And again, that may or may not come in 1st of April. It's supposed to, but we're not sure yet. My gut says inquiries are likely to continue at the current level. We definitely saw, obviously, we had that huge peak. We've seen it come down. Seems fairly stable now. It's hard to know what percentage it's sitting at. We haven't had an RDCF in a while. I don't know if anyone on the call has any kind of feel for it. I feel it we're probably somewhere between 10, 15, 20%, somewhere around there. And it seems to have settled at that. So I will say that anecdotally, people are reporting more success in defending inquiries. They're reporting more responsiveness from HMRC, fewer stupid questions from HMRC. So we're hoping this is it kind of settled down now and it's going to go back to being what it always was, which was a really good opportunity to have a conversation with HMRC about claims and what they consider eligible and what they don't. So hopefully this will maybe not reduce, but improve in terms of the way these things are handled. And obviously, over the last couple of years, the impact of AI on all areas of accountancy, but especially R&D tax relief, has been massive, and I think that will increase. We know that HMRC are consulting with industry leaders about the use of AI in R&D tax and how people are using it, what they're using it for, what aspects of claims are being prepared using AI. So it'll be interesting to see what HMRC do with that information. One thing we have seen, we saw again, fairly anecdotally, HMRC had made a statement in an inquiry letter saying that they could tell that this claim had been submitted using AI-based software. We don't know what software, but AI-based software. And they felt that this undermined confidence in the competency of the professionals preparing the claim. So again, we don't know whether this is a team-wide opinion on AI and R&D, whether that's an individual inspector or whether it's a whole kind of R&D tax relief team attitude. But we are seeing a little bit more of HMRC recognizing claims that have been prepared using AI and starting to push back on them a little bit. It seems a bit weird that they're doing that at the same time as consulting with leaders in the use of AI and R&D tax. So I think they are trying to work out what their attitude is to this and what they should be doing, how much they should be pushing back, that kind of thing. So again, the impact will only increase. But I think 2026 is the year that HMRC really have to come up with what their line in the sand is about the use of AI, both on their side and on the side of claimants, and how those things are going to interact. So it should be an interesting year from that point of view. Obviously, we won't see much out of HMRC, but anything we get, we will pass on. And now we are going into questions.
Question time. Then I'll give you a couple of seconds just to catch your breath before we dive into questions. This is normally the moment where we see lots of hands shooting up, or everyone goes very, very quiet, and there's crickets and tumbleweed everywhere. So please do feel free to ask us a question. I can see I've got two already to go. Everyone's probably worried about going first, so please don't worry. Let's just make it really, really easy. There's no judgment here. It's the first year of the merge scheme, and the rules haven't been anywhere near as simplifying as they were kind of advertised to be. So if something does feel unclear, you're in really, really good company. So please feel free to ask away, whether it's legislative nuance, a certain scenario, process challenges, anything at all. Please just feel free to jump in and type your questions in the Q&A box. Mark, I've seen your question in the chat, so don't worry. I'm just going to go to Fiona first for Jen. So let me just grab Fiona's question up. So this is for you, Jen, from Fiona. If you have any employee who is resident in Ireland and paid through an Irish payroll, can you still include them as employee costs, or would they be an EPW and the cost not allowed if they're not paid through a UK payroll?
So this question has come up a lot. As far as anyone can tell at the moment, an employee is an employee. It doesn't matter where they're registered. It doesn't matter if the company has an overseas payroll function, that kind of thing. If the company is employing them directly and paying them, it doesn't matter. They're always an employee. They would only be an EPW if they were employed through a third party and then those costs reimbursed by the claimant company. So to be an EPW, you've got to have that tripartite agreement anyway. So as far as we're aware right now, overseas direct employees of a company can absolutely be included. This might change over time, but for right now, it seems absolutely fine that you could have employees based anywhere in the world paid through whatever kind of payroll, as long as they're direct employees of the company. This may change over time, as I say, but for right now, that seems to be, it has always been the case and continues to be the case.
Thank you. Sorry, my alerts suddenly started going off. I do apologise, everyone. Let me quickly go to Mark, because your question was ahead. I've got another question as well coming up. A company last did a successful R&D claim up to year end June 2022. Do they need to do a CNF for new claiming period July 24 to 25?
Okay, so this again is one of the small confusions I see a lot. It depends on what date the R&D for June 2022 year end was submitted. So it doesn't matter that it's for June 2022 accounting period, it matters what date that was submitted and whether it's in the 3 years prior to. So if it was July 2025, so the window for that is still open, so you can still do one. Possibly I would anyway. But if it was within the 3 years back from, my brain won't let me do this, but 3 years back from 6 months after the end of July 2025, so that would be January. Yeah, so as long as it was submitted within that window, you'd be fine. It doesn't matter, as I say, what accounting period it's for. It matters the date it was submitted. Obviously, you then need to look at whether it was an amendment or not to see whether you can count it. So there's a lot to think about there. I can't say for sure because I don't have all the information. Because the window's still open, I would potentially just do it, but definitely go back and look at the date the claim was submitted on and work it back from there.
Thanks, Jen. Hope that helps, Mark. Okay, I don't think we can answer this question, but it's just a good one to have posed in the webinar, given what we're talking about. So, a question from Anonymous. I had a client who fought HMRC for 2 years and eventually won an inquiry in full. Meanwhile, the CNF was missed for their following year, as they were being told the R&D did not qualify. Would that be seen as an exceptional circumstance?
So I can't say for sure. As you said, I can't give a definite answer to this because HMRC haven't published a list of exceptional circumstances or anything like that. I would hope they would see that as an exceptional circumstance. If they have then allowed the claims, I think it's absolutely justified to go back to HMRC and say, well, we didn't do a claim notification form because you told us the claim wasn't eligible, and now you've said it is, so we've missed the window. It's always worth a try. The worst they can say is no. This is quite a most people, it's not exceptional circumstances. It's just they've misunderstood the rules or not known about claim notification time or whatever it is, or not started working with the company in time. Claim notification window's been missed. So we haven't had much information from people that have appealed this process as those and gone down the exceptional circumstances route to know what exceptional circumstances would be accepted. I would 100% try it because, as I say, the worst that happens is HMRC say no and you miss a year of claim, which is awful for your client, but the best they can say is yes, okay, fine, do it, and then you get that claim back.
Thanks, Jen. Okay, another question from Thorfinn. For subcontracted costs, I have a client who uses a UK software company for their development work. Is it my client's responsibility to find out if that UK company is using overseas employees or freelancers, or does it not matter given that as far as they know, it's a UK-based developer company?
So again, this is something that hasn't been tested hugely. The rules would say that even though they're using a UK software development company, if that UK company is physically doing the R&D overseas, then it wouldn't count. So it is your client's responsibility to check with their subcontractor where that work is done. Again, it's not been tested massively in the real world yet to know actually how HMRC would take it. But I would say absolutely yes, your clients should be looking at who they use as subcontractors and where that work was physically done, because that is the rule, that if the work was done outside of the UK, you can't claim it. So absolutely, they have to be asking those questions.
Thanks, Jo. Great question. Thank you, Thorfinn. Peter has, hi Peter, how are you doing? You've just given us a tidbit of information. So you've got a client who's missed the CNF window due to being sick, burnt out, and has a doctor's letter supporting their claim, and you're attempting to make a claim and make the case, I presume, for some sort of exceptional circumstance. So that's interesting. It's good to hear that you're changing HMRC on that.
I've always, so anecdotally again, obviously there's quite a few times with HMRC where you might want to plead exceptional circumstances. So a lot of the time it's where inquiries haven't been responded to in a timely manner or deadlines have been missed. And the only ways I've known that to be successful are medical reasons. So they do seem to be historically quite sympathetic to medical reasons, especially if you've been communicating with them throughout. So obviously with an inquiry process, if that company's been communicating with HMRC, they know they've been there and working with these things. You've got a case that we weren't being remiss, we weren't just ignoring you, this happened. And I think medical reasons are quite a good one. So fingers crossed on both cases.
Absolutely. Thanks for that, Peter. Okay, I think that might be all of the questions. It might not. I will do some more chatting away, just in the anticipation that there might be some people still typing. Just really just to initially just say thanks everyone for joining us today. It's been a great session. Thanks so much for all the participation. It's always really great to hear your questions and to be able to answer them live. And we hope this has given you some clarity around the new regime and how to apply the new rules in practice. As I've already said, a recording will be sent out this week, so don't worry if you have missed anything where you want to revisit certain sections. And if you would like to explore how WhisperClaims can help your firm deliver R&D claims with more structure, consistency and confidence, we do have an app showcase session running next week. As I said, I'll pop the details in the chat in just a moment. It's on the 3rd of December at 12 noon. And of course, if anybody would like to talk to us one-to-one, please feel free to reach out directly. Again, I'll just pop my contact details in the chat in just a moment. Would love to speak to you. I think that might be it for everybody. It's all dried up a little bit, I think, for the questions, but thank you again so much. We hope you haven't found it too overwhelming. There's been a lot of information shared today, and there's a lot to take on board. That's just the reality of the situation. So yeah, well, we hope you all have a wonderful rest of your Tuesday, and we hope to speak to you all at some point again soon. Look out for your invites in your inboxes for our next sessions, and if we don't hear or speak to you before, have a lovely festive season next month, and please don't hopefully get too stressed out over the the deadlines for December submissions. Yeah, take care everyone, speak to you soon. Cheers.